Hello, I'm Delwin Graham of Graham Wealth Partners, which is part of Canaccord Genuity Wealth Management. We're portfolio managers, and I thought it would be a good time to talk about how we think about risk. Risk in the industry is thought about many ways, probably the most popular as in terms of volatility, how much a stock or a bond goes up and down. We like to think of it more in terms of time lag, the lag between when you buy an investment and when you sell it, because in that lag is risk. I'll give you an example. In terms of stocks, when you buy a stock, you buy it in the present, looking to profit in the future. When you sell it, that's where you get your capital gain. But that's also the case of a bond. You buy it in the present, and you're looking to get your coupon payment in the future. Whether it's next quarter, next year, it's always in the future. In that lag between the present and the future is risk, because things happen in that lag. So in the case of stocks, you could have a bad quarter, which kills your stock price, or you could, in the terms of bonds, you might have the actual issuer itself go bankrupt, and which obviously affects the bond itself. So the future is opaque. But there are touchstones, and what we do is we use our models in order to get a grasp on the future as best we can. So that's probably the most obvious in the case of a financial plan, because a financial plan, basically what they do is they take historical averages and they project it into the future. So they might take a look at the historical average for return of a balanced portfolio and project that forward for the next 10, 15 years as an idea of what you could expect to get as a return in your portfolio. Similarly, they also project the average lifespan of a man or woman to give an idea how long you can expect, or not you can expect, what could be expected in the portfolio for longevity. In the case of stocks, we use our charts in order to track the past performance of a stock into the future. So what we use is a moving averages. It averages the price of a stock over a period of time in order to get a general view of the trend of a stock, and hence project in the future what we're likely to expect. To the extent the trend continues, and if the trend is up, well, that's a good thing. The assumption in all of this, of course, is that the future will look like the past. But that's always going to be somewhat of a false assumption, because the future will never look exactly like the past. And so we have to make sure that we are very careful about magical thinking, which is where we think that our models, which are, we see them as very eloquent or very well researched, we see them as being the reality rather than a reflection of the reality. So what happens is, oftentimes you become so convinced on your model that you hold on to your stock position or your allocation all the way down. A lot of money has been lost by investors who are waiting for the market to come to its senses. In fact, there's an old stockbroker saying that the market will stay irrational longer than you will stay solvent. So how do we protect ourselves against this magical thinking, which is actually wishful thinking? Well, first, we use a little humility and review our assumptions in our stock portfolios, also in our financial plans, and even in our individual selection of stocks themselves. So we might review these annually, semi-annually, daily. We also look to protect our downside by diversifying our portfolios. So this is a passive means of downside risk. So what we do in terms of portfolio creation, we diversify between asset classes. That is, between bonds and stocks and alternatives. We also diversify within asset classes. So we diversify between different sectors in the stock portfolio and between different issuers in a bond portfolio. How it would work in a bond portfolio is that we diversify perhaps between government bonds and corporate bonds. Government bonds typically have a bit lower yield, but they are more secure, whereas corporate bonds have a higher yield but more risk. That's passive diversification. We also use and are very adamant on using active downside protection in our portfolios. Now, that's quite obvious in something like a financial plan where we use insurance in order to protect our clients from unforeseen events like premature death or premature disability. But we also use our charts in order to protect ourselves on the downside on our stock portfolios. That way we can react to situations as they come, so we can get out of harm's way. So to the extent that what we presume is an upward trend is broken and started trending down, we want to be out. In fact, what we think is that active management is the only responsible way of managing the risk in a portfolio because it's responsive. Thanks for watching. Please like and subscribe, and check us out at www.grahamwealth.com.